How the hidden cost of mutual funds destroy your portfolio. Early in the morning for me, my friends. Woke up early because I had this going through some old articles I had written a few years back, which I'm going to share with you right now. I forgot about this. I forgot about this. How there's a unseen cost in mutual funds and probably ETFs as well. But we're going to talk about mutual funds here in particular because most people still invest in mutual funds. My presumption is ETFs will have the same cost, but it might not be as drastic as funds. I tell you, the industry, it's so flippin' expensive. The industry exists to make the industry rich. That's all there is to it. They don't exist to make you rich. Always remember that. They exist to make the industry rich, which means there's just layers and layers and layers of fees on top of fees. And some you're not going to know. And some isn't disclosed. Some are hidden, even the SEC. All right, so let's just dive into this. The article I'd written probably 3 years ago, how the hidden fees of mutual funds hurt your portfolio. If there's anything I've noticed about the industry is how hidden fees are on various products. All products have fees. I'll put links in the show notes, by the way. How do you know there are fees? Because if people didn't make money selling the various products, the product would not exist. So we're going to talk about mutual fund expense ratio, which is the fee everyone sees. All right, and so I'm using Fidelity Magellan here, and we're showing the expense ratio. This is a few years back. Let's see what the Fidelity Magellan fee is right now. Hold on just a second. This is a few years back is 0.67, which is actually higher than it was in 2013. But if we go to MarketWatch now, it's 0.76. So why is the fee on Fidelity, the expense ratio, going up? That's odd to me. I don't know what to make of that. I haven't followed other funds. I just know Fidelity Magellan because it's the first fund that I was actually introduced to, for the most part, when Peter Lynch had written his book One Up on Wall Street. So that's interesting. Don't get that. Anyway, so let's keep looking here. So the expense ratio is 0.67, which means it costs $6.70 per $1,000 invested per year. All right, which is pretty low relative to the average in the industry. The industry average is about 1 point, probably nowadays. It used to be 1.24, it's probably 1.1 now. For expense ratios on equity funds, I'm not talking bonds. Bonds about probably 2/3 that, probably 0.75. But I want to share this with you. There's more than just the expense ratio. The expense of your fund doesn't stop at the expense ratio. Trading costs also are an expense that is not part of the expense ratio. Here's what a couple finance professors say. We found that the fund's annual expenditures on trading costs were comparable in magnitude to his expense ratio. So we click on this link. And I forgot all about this, man. And I said, I need to do another video on this because it's, back when I did this video initially, I didn't have that many subscribers. So I'm sure not that many people have seen this video. And these guy, Greg Cadlick, and I think it's Virginia Tech. This guy from Oregon, UVA, and I think, I thought it was a guy. One of these guys used to be from Oregon. Be it as it may. We got California Davis, UVA, and Virginia Tech, Greg Cadlick. Cadlick I've read quite a bit. I think he's written a bunch in the JFP, Journal for Financial Planning, which I've since boycotted since they started getting into critical race theory and stuff. Industry observers have warned about the invisible cost of fund trading, a la John Bogle. Yet evidence that these costs matters is mixed because many studies do not account for the largest trading cost component, price impact. Using portfolio holdings and transaction data, the authors found that the fund's annual trading costs are on average higher than their expense ratio and negatively affect performance. So if we go back to Fidelity Magellan, we see expense ratio 0.76. We talk about these guys, the annual trading costs are actually higher than the expense ratio. That's nuts. The expense ratio is one of the few reliable predictors of mutual fund performance. I actually had did a video on on why you should invest in the highest ratings Morningstar funds, the 5-star funds. However, as noted by John Bogle and other prominent industry observers, the expense ratio captures only the visible costs of mutual funds. Funds incur a host of invisible costs that are less transparent to investors. All right, so let's just keep reading my article here. That means the actual trading costs of the funds are essentially the equivalent of the fund's expense ratios, thus doubling the cost of the funds. But where do you see those costs? You can't. Trading costs are nowhere to be found. It's completely hidden from the view of the investor. And it's not in a prospectus. It's not in any SEC data file. Nothing. I wish I could say it's just a couple of rogue professors making this argument about fund costs, but industry bugaboo for years. John Bogle, the founder of Vanguard RIP, has cited these many funds as a cost that investors pay without knowing it. So what can you get for an example of trading fund costs, given it's such a prominent expense? Well, a lot of people say look at the turnover. All right, so here's Fidelity Magellan, turnover 42% back in 2019. Let's see what it was here. Turnover 106% now. Man, what is going on? Do they got a new manager or something? I'm just curious. Can we see the manager here? On Market Watch? I guess. Okay, that's weird. You can't see the manager. All right, we have to go to finance at Yahoo. All right, so let's go to finance Yahoo. FMAGX. We'll look. Futures are off and running here. All right. FMAGX. Let's take a look at the. Let's pause it. Here's Fidelity Magellan on profile. So let's look at the profile of. Oh yeah, they got a new manager, Sammy Hagar, Sammy Simonigar. So he just took over, man, in 2019, so less than 2 years ago. Yep, there you go. So when he took over, expense ratio went through the roof, turnover was high. Well, I won't say through the roof, but so he got rid of all the old stuff and all right. Anyway, you can see towards the very bottom of the screen we have turnover, a percentage of 51%. It's actually 42% for Fidelity Magellan. Now it's 106%. If Fidelity started with the year with 100 stocks, how many stocks are traded during the year? So what turnover means is that in this case, that nowadays Fidelity with 106% turnover. Let's see. That means they've traded. Where is it freaking now? They got 0.77 there. It's nuts. That means they turned their portfolio over 100%. The entire portfolio was turned over. I can't remember. See what this thing is. But anyway, I thought it was under profile. Is it not? Turnover right there. That means they turned over the portfolio one time. So they had 100 stocks. They sold 100 stocks. If they have 100 stocks, they got a portfolio turnover of 50%. That means they sold 50 stocks, if that makes sense. So the higher the turnover, the more trading, the more cost. But that's just turnover is a percentage of the portfolio has been traded during the year. But that does give a true indication of trading costs. Not all of it, though. Not all of it. For example, and this is from this article right here, what we just talked about, shedding light on the invisible cost, trading costs, and mutual fund performance. For example, a 500 million small cap fund with a 50% turnover will have a much higher trading cost than a 100 million large cap fund with a 100% turnover, despite the former's lower turnover. The reason for that is, let's talk about it. Because to go back to our professors, the difference in average annual return for the funds in the highest and lowest quintiles of an aggregate trading cost is 1.78 percentage points. And we're going to talk about why that is. All right. You read that right. 1.78% you could lose in returns if your fund has large trading costs. Unfortunately, there's absolutely no way for you to know what these trading costs are. So why do we have funds that have higher trading costs even with a lower? So let's go back to this. A 500 million small cap fund with a 50% turnover will have much higher trading costs than a large cap fund with 100% turnover. And the reason is why is simple. Because the aggregate bid to spread price. All right, so we developed a detailed position by position measure of funds' annual expenditures. First, we use quarterly portfolio holdings data to determine each fund's position changes on a stock by stock basis. Second, for each position change, we applied an estimate of the cost of brokerage commission, bid-ask price, and price impact of trading that amount of stock in the quarter. Third, we computed each fund's annual expenditure on trading costs by aggregating the cost of all trades of the fund over the year. We applied this to our sample of 1,758 domestic equity funds. We find that funds' annual expenditures on trading costs were comparable in magnitude to the expense ratio. Moreover, we find there's considerably more variation in fund trading costs and expense ratios. For example, the average expense ratio of small cap growth versus small cap value was about 0.32 percentage points, whereas the difference in average aggregate trading cost was 2.33. The more important question concerns how fund expenditures on trading costs relate to return performance, and it's well significant. Sorting by expenses, fund total net assets or turnover yielded no consistent monotonic pattern of return. In stark contrast, sorting funds on the basis of their aggregate trading costs yielded a clear monotonic pattern of decreasing risk adjustment portfolios to the extent of 1.78% a year. To address, and the empirical evidence, the relation between fund turnover and fund performance is ambiguous. We conjecture this ambiguity is due to the fact that turnover does not account for the differential cost of trades, which depends on the fund size. And he talks about what I just said, a 500 million small cap fund with a 50% turnover will have a much higher cost than a 100% turnover with a large cap fund because there is less volume. The lower the volume, the higher the bid spread price. I tell you, so just think about it. If you are buying, I don't know, freaking $5 million homes, all right, the bid spread, the ask price versus your bid price is going to be significantly more spread, a higher spread than if you're buying, a 3-bed, 2-bath under 200,000 home. Why? Because those homes are less in demand. There's less volume for those $5 million homes. There just isn't. So the fewer buyers can say, look, I'm not going to give you your 5.2 million offering. I'll give you 4.99. The bid ask is significantly higher. The spread versus if you got a 200,000 3-bed 2-bath on a quarter acre. I mean, you're asking 200,000. The guy might say, I'll give you 190. You see what I'm saying? The spread is much, much lower simply because there's more volume on there and there's less price too. If that makes sense. So I mean, it's less. The volume is what matters. Is there more volume? The guy says, I don't need to drop it by $10,000 because there's another guy who's going to buy it. Whereas the guy at the $5 million range says, there's not that many buyers out there in this category, so I will drop it. And that is where the difference is. So that's where I was saying, I did a video the other day talking about micro cap stocks. Drawback about micro cap stocks is you're going into, there's just not much trading volume. So if you're buying a heavily traded micro cap position, the fees are going to kill you, man. Kill you. That's why index funds are just always the way to go. Large cap index funds, obviously, but small cap index funds as well. It's simply because there's going to be less trading volume, which means you're going to get less smoked on the bid-ask price, which means you're just going to keep more of your money. It's just all there is to it. So you don't want high turnover, and you certainly don't want high turnover in small cap companies because the bid-ask price is so high. The trading costs are significant and actually add a doubling to your overall expense. And a lot of these actively managed are already cost heavy. And we know that for a fact, and that hurts your portfolio performance. Hope this helps. You got to watch the size of the fund, what they're engaging in investing, and you just got to watch the cost because the cost will eat you alive when you don't even see it. Hope this helps. Love to hear your comments. Links in the show notes. Thanks now.